Good morning and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, economy, financial services and markets. I'm Lizzie Burden in London. Well, coming up this morning, with less than 2 weeks until what could be Chancellor Jeremy Hunt's last budget before the election, we'll explore the potential for tax cuts after Britain saw the biggest budget surplus on record last month. Also ahead, we're going to digest some of the latest UK corporate earnings, including Anglo-American and Lloyds Bank. Plus, we'll take a look at the health of the high street as The Body Shop starts shutting nearly half of its UK stores, and the British electrical retailer Currys becomes the target of a bidding war. But first, let's start with the Bank of England. The Governor, Andrew Bailey, told lawmakers earlier this week that market bets on lower rates were not unreasonable. Take a listen to what he had to say about the prospects for cuts.
We don't need, obviously, inflation to come back to target before we cut interest rates. I must be very clear on that. That's not necessary. So we'll be looking for sustained progress on those things to reach that judgment about how long this period of restrictive policy needs to be. But we have very clearly signalled this change.
So that was the Bank of England Governor Andrew Bailey speaking earlier this week at the Treasury Select Committee. And just breaking across the terminal, we do have the latest PMI data for the UK economy for February. And manufacturing, it is a beat. 47.1 is the reading. The estimate was for a miss. 47.1. The estimate was for 47.5. For services, the estimate was 54.1. It actually come in at 54.3, so a slight beat for services. And on the composite level, 53.3 is the reading. The estimate was for 52.9, so another beat there. Of course, these numbers absolutely crucial for when the Bank of England is going to cut interest rates. There's been a lot of complaining recently about the labour market data and more of a focus on the PMIs as we're at this pivot point. Swati Dhingra, the dove of the committee, actually complaining about that labour market data yesterday. Although, let's just note, the PMI doesn't cover construction and retail, very sensitive to monetary policy. Doesn't cover public sector activity either, very sensitive to strikes. So let's get analysis then of these PMI numbers and where they leave the rates outlook with Dan Hanson, Chief UK Economist for Bloomberg Economics. We're also joined by our UK government reporter, Joe Mays, for the political context. Dan, the PMIs, does it change when the BOE will cut?
I don't think so. I mean, you said there it's a slight beat on the composite, but it's basically in line with where it was last month. I think what we know now, or getting more and more certain of, is that this technical recession that we had at the end of last year, it probably only lasted for 2 quarters. The economy is clearly picking up. All of the survey indicators, the sentiment indicators, we haven't had any real hard data other than the retail sales, and that's obviously all over the place month to month. But I think the big picture here is that the recession, if you want to call it a recession, is probably over. The economy is picking up. I think for us, at least, the pickup in growth is going to be fairly modest, though. There are still a lot of headwinds facing the economy. We know that. But I think if you compare on paper, when we look back on 2024 relative to 2023, it'll be a better story and a stronger growth story, for sure. OK,
the other thing that Andrew Bailey said when he was at the Treasury Select Committee was that they don't need to have inflation at 2% to cut rates. This was the market-moving comment. Did he actually tell us anything we didn't know by saying that? They always focus on the medium term, don't they?
Yeah, they do. I mean, I thought it was really interesting, actually, because if you look at the path of inflation over the next, say, 6 months, what we've got is the first quarter of this year, we're almost certainly going to be above 2%. Going into the second quarter, it's been well built now, but there's this narrative that's built, and we believe in it too, that inflation will get to 2, probably below 2 actually. And then there's a question mark about whether you get this resurgence, which is something that the bank was talking about, and it's in February, at its February meeting. We're a little bit less sure that will happen. But for me, I think what he's saying is that all meetings are live now. Really, it's a real question. And this is what they've said. How long is policy going to remain restrictive? And it's only really in the first quarter that inflation is going to be above 2. So to me, that's saying, well, we're going to be thinking about it in March. We're going to be thinking about it in May. The market's thinking August for the first cut. I still think the second quarter is a decent bet for when they'll cut rates. I think there's going to be a lot of good information that they'll get, a good story that will come through, particularly on the CPI data in the run-up to that, and it'll green-light them to cut rates a little bit at least.
OK. Well, speaking of the data, yesterday we saw the UK posting a record budget surplus. It gives the Chancellor potentially a bit more headroom ahead of the fiscal announcement, the spring budget. Joe, do you think that the Chancellor would knock 2p off income tax, as some members of his party would like him to?
I think he would like to do that, very much so. But I think the fiscal headroom position is restrictive for him. I think that, at best, internally, they think they could perhaps manage a 1p cut of income tax with how it stands at the moment. But they have levers they can pull, such as reducing the public spending assumption in future. That could give them some more headroom. They've got their fingers crossed that the OBR is going to come back to them and say, you do actually have more headroom than currently. But as it stands, the position is still quite restrictive. So they'd love to do 2p. I think, at best, they can probably afford 1p now.
OK, well, let's put the fiscal aside, but other measures that could be announced in the budget. You got the big scoop that the Chancellor's looking at potentially changing rules for pension funds so that they have to disclose how much of their assets are UK assets, setting a threshold for that. We've already heard that maybe Jeremy Hunt's interested in a British ISA. Do you have any more details on how all this would work? Are you hearing that you could have both the measures at the same time?
Yes, that's a possibility. I mean, the Chancellor is really looking at what can I do which doesn't cost that much money, which would nevertheless spur the economy and generate some positive headlines for the Conservative Party. So, as you say, British ISA is very much a prospect, allowing people to have that tax-free savings account where they can put money in UK equities, and that would boost the British stock market. That's a consideration. You mentioned pension funds, but there are a whole range of other measures that we could be looking at. Measures to support the housing market, for example, potential 99% mortgages, that's a possibility. So, yeah, there's a whole range of options that Hunt has, but the bottom line is money is tight, and that's why we're kind of in this realm of looking for such policies.
Well, Dan, on that point, how seriously should we take the public finance numbers for January? Because there's always a bit of a pinch of salt needed when it's the start of the year.
Yeah, absolutely, and there's always a surplus in January. Like, that always happens. So, for me, at least, I looked at it yesterday, and it's sort of the OBR's forecast. It looks like for this year, at least, there's a bit of an undershoot. That's obviously good news for him. I mean, just going to the point that Joe made, I'm quite sceptical that I think they're downplaying the amount of headroom they have.
Well, that's classic Sunak, isn't it?
Exactly. I mean, he did manage expectations,
over-deliver.
and he did that. Hunt did that in the run-up to the autumn statement. If you look at the interest rate assumption that will be used, if you look at what's going to happen with the population projections, the only thing that's offsetting that is slightly weaker inflation, which will impact how fast wage growth will grow, and also, obviously, how fast national insurance and income tax grows. But I think all the signs, if you look at the sort of baseline assumptions, all the signs point to them having a bit more money than they're letting on. So I think maybe not 2p, but I don't think a 1p income tax cut is out of the realm of possibility in terms of the space that he has.
Joe, I said it might be Hunt's last budget. What do you think the chances are that Sunak replaces him before the election, perhaps with a woman?
I think that's unlikely, but there could also be another budget before the election. That can't be discounted either. It could be the case they think we don't have enough money at this budget to do something eye-catching. Let's do another budget later in the year when perhaps the economic position has improved. So that's also a prospect. But I think it's unlikely that Sunak gets rid of the Chancellor.
Just away from the economics for a moment, we did have absolute chaos in the House of Commons yesterday. This vote over the Israel-Hamas war really triggering the chaos. Take a listen to the Speaker apologising.
I have tried to do what I thought was the right thing for all sides of this House. It is regrettable, and I apologise for a decision that didn't end up in the place that I wished for.
Even rowdier than usual in the House of Commons, Joe. What on earth was going on?
Well, I mean, this was all about the SNP wanting to put forward their motion. It's an opposition day, their opposition day, put forward their motion on the Gaza, Israel, and having a permanent ceasefire, and then Labour wanting to have their own motion because they didn't want to vote for the SNP wording, and the Speaker being under massive pressure to allow that Labour vote to happen because Labour MPs were saying they were facing threats and so on if they didn't vote for their own motion, and Speaker Hoyle effectively ceding to that Labour demand, but then the SNP being absolutely outraged that their motion had been kind of superseded on their own opposition day, and the Conservative Party also weighing in. And then, effectively, the situation now is Speaker Hoyle really battling to maintain the confidence of the House in his position as an impartial Speaker. So that's the real fallout, I think, of this. His position now being under threat, and we'll have to see in the coming days whether he can survive as Speaker. I think that's the real takeaway.
Yeah, really interesting. So Lindsay Hoyle's future on the line in the balance there. Well, Joe Mays, our government reporter, and Dan Hansen, UK economist for Bloomberg Economics. Lovely to have you both on. And coming up, we're going to dive into earnings again. Lloyds setting aside £450 million to pay for possible compensation linked to a UK review of car finance. We're going to bring you more on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Lizzie Burden in London. Now, Lloyds has set aside £450 million to pay for possible compensation and other costs linked to a UK review of car finance. Still, the bank pledged to buy back as much as £2 billion of its shares. And for more on this, I'm joined by Bloomberg's Will Shaw. Will, let's just talk about this Financial Conduct Authority review into historic car finance arrangements. What are the chances Lloyds doesn't have to spend the full £450 million on this compensation? What's the wider context?
So there's been quite a bit of worry building up about how this might affect banks, and in particularly Lloyds. So like you say, we heard today that they've got £450 million which they've put aside. But there's a couple of lines in the earnings that are a little bit more worrying than that. So the bank talks about there being significant uncertainty as to the extent of misconduct and customer loss, and says that the costs could change. So the worry at Lloyds obviously will be that this money could creep quite a bit higher. Now, so for years, just by way of context, Barclays, Lloyds and other banks made large amounts of money through funding car purchases. That party is now over and questions are being asked. So the FCA is looking into what customers were told about the commissions that dealerships were being paid. There is indication that the amounts of money involved could get quite scary. Analysts told us that banks could face a bill of up to £10 billion. So Lloyds will be hoping at the moment that it stays very close to 450, I think.
And Will, the good news is there was a slight beat on profit. How much of that comes down to Lloyds collecting its debts from the Telegraph newspaper?
I suppose I don't really want to go into the detail of that, not least because I don't have that information in front of me. But the pre-tax profit is 1.78 billion for Q4. Like you say, that's a bit better than was anticipated. You've got the £2 billion share buyback coming, the dividend going up. So things are looking positive generally for investors, but you wouldn't really see that. You can't really see that in the market this morning. There's not much exuberance about all this. At the same time, there's not too much drama. Like if you compare to Barclays earlier this week, they had a big jump in the share price due to their optimism about their big strategic plan. HSBC, meanwhile, yesterday got pummeled in the stock market after they disclosed this charge of $3 billion in relation to a Chinese bank that nobody saw coming. In Lloyds, £450 million, it looks quite small compared to that HSBC charge. There's not much drama that we can see going on in terms of how this is being received.
OK, Will Shaw, all across the twists and turns of the banking earnings out of the UK this week. As you can see there, most in the red this morning. Lloyds shares down 0.8% off the back of their results. But let's get to other results we've had out of the UK today. Anglo-American for the miners. We had a conversation with the CEO, Duncan Van Blad, earlier. The shares currently are up 3.5%. So let's see why.
The biggest impact to earnings in the business from last year to this year has absolutely been in demand for diamonds and prices for PGMs. That really does put quite a lot of cost pressure into the business on top of the normal inflationary issues that we saw during the course of last year. And that has required quite a lot of self-help in terms of making sure that we get on top of those things and protect the balance sheet, which I think there is some very clear evidence that we are onto and already making some great achievements in.
Duncan, how hard is it to contain inflation within the mining sector right now?
Yeah, there are normally two types of inflation in mining, guys. So, the first of those is just the natural inflation associated with the resources that you're mining, because the way we set these things up, you mine the high grades first and the stuff that's closest to the infrastructure first, and as time goes by, you move away from these infrastructures and into the lower grade areas of the mine, and that's a form of inflation that we refer to as mining inflation, and that's very natural. Most of our job is trying to keep ahead of that in terms of productivity improvements, ahead of that by the application of technology improvements to the processes. And then there is the global commercial inflation that happens. Now that tends to come up, bite really hard in terms of the input costs, things like diesel, reagents, etc. But to the extent that eventually falls away, there's a little bit of elasticity into that. And so that's the one that if it's peaked and starting to come down, we will start to see some relief of pressure to that. But what we don't get the relief of is the mining inflation side of that equation.
Good morning to you, Duncan. Can I ask you about iron ore and the Brazil operations? You're doing a deal, it seems, with Vale this morning. Some people responding to that saying, is this expensive, or asking if this is expensive? Maybe that's their assessment, but others suggesting maybe the synergies that you and Vale can get out of it justify the price. How do you justify the price?
Well, Anna, this is one of those unicorn time of opportunities that you get in mining. Very difficult to rarely get proper industrial synergies in mining, where you either share a resource in the likes of an ore body or resources in terms of infrastructure. And this is exactly what you have here in terms of this arrangement that we've concluded with Vale. We have an operating mine full of infrastructure. They have a resource, the quality of which is better than the resource that we're mining on as it stands today. The combination of these two means that over time, we get a better product for a much longer life of mine at a much lower capital cost. And I think that on that basis, it's a hugely value accretive deal for both of the parties. On top of that, given the size and the nature of the combined deposits now, we also have the potential for expansion opportunity in what is going to be one of the most richly sought after commodities, high quality pellet feed iron ore, which is going to be absolutely crucial in clean steel making in the future.
OK.
Just very briefly, what's the macro read? Give me sort of 10, 20 seconds on China. We've just seen French PMIs, manufacturing picking up. You're seeing that in the States as well. What do you see as the kind of the macro backdrop on which you're operating? Yeah, so look, I think much of this is generally going to be defined by geopolitics more than anything in the short run. There are about 60 countries in the world this year that are going through some form of election, and I think that probably plays a little bit heavily into the macroeconomic milieu for the next year or so. So, whilst I, like many others, are starting to see a few green shoots in many of these economies, I think it's probably going to be a little bit range-bound for the duration of this year before we start to see any material turn.
So that was the Anglo-American CEO Duncan Wanblad there, making the positive case for his company. The shares up 3.9% this morning, despite the downturn in the diamond and platinum market, which really is quite unique to Anglo-American as a London-listed market. Revenue a shade lower than expected. But coming up, we're going to bring you more on the UK high street. The Body Shop is preparing to close at least half of its UK stores. So we're going to take a look at the future of Britain's shopping. Stay with us for that. That's next. This is Bloomberg. The Body Shop is preparing to close almost half of its UK stores after the retailer's British operations fell into insolvency last week. It comes as Currys' largest investor backed the electrical retailer's decision to reject a £700 million offer from Elliott Investment Management. Well, for more on both of those stories, I'm joined by Bloomberg's Sabah Meddings. Sabah, let's start with Currys. The whole reason that Elliott was swirling was because of this lower demand for electric devices in the cost of living crisis. How likely is it, therefore, that you're going to see another overseas buyer try and step in?
Well, we've obviously already heard that JD.com, the Chinese conglomerate, may be interested. So we could be in for a bit of a bidding war here. Obviously, for them, that would give them a foothold into the UK market, perhaps sort of expanding geographically when the domestic market has softened. So there is potential, and obviously there's a long list of private equity companies that could come looking, particularly when we think about valuations. Obviously, Currys share price, like many in the UK market, has been somewhat dampened, sort of down 70% since 2018, so it's looking really cheap.
Yeah, and the biggest shareholder in Currys, Redwheel, I see, has asked the UK government to try and encourage investors to buy UK equities. I wonder if there's any link to what we were just talking about with Joe, his scoop about pension funds, maybe the Chancellor looking to get pension funds to hold a certain amount of UK assets. Do you reckon that will work? Do you reckon there's any link here?
I mean, certainly the UK is feeling unloved. You know, obviously investors have pulled a lot out of UK equities. I mean, there are sort of moves afoot. We're talking about maybe a British ISA that might encourage savers to put more of their cash into UK stocks. But, I mean, really, how much this is really going to move the needle? Can you force investors to put their money where they perhaps don't want to? I mean, so who knows? It's all to play for into the election, I guess.
And what about the Body Shop? What went wrong here when I thought that ESG was in vogue? I thought that companies that were not testing their products on animals would have been fashionable.
I mean, it is, but there's so much competition. And I think we can all remember what the Body Shop used to be. I mean, it was pioneering. They kind of pioneered this whole ethical beauty, but there's so much competition. People like to shop online. Do they want to be sort of advertised at by influencers? There's all this there's so much competition, so much online, and Body Shop was so high street heavy that it's been hard for them to compete.
Well, I'm very partial to their face masks. Others are available, though, it has to be said. Sabar Meddings, thanks for those two stories, staying across what's happening on the UK high street. You can get a daily dose of British politics from me and the rest of the Bloomberg UK politics team on our podcast. Do subscribe on Apple, Spotify, or wherever you get your podcasts from. I just want to recap those PMI numbers that we got earlier in the show. A beat on the composite number, but misses on services and manufacturing. You've got gilt yields slightly lower on the 2-year, steady on the 10. That's it from today's show. This is Bloomberg.